Hello, my name is Michael Joyce from JoycePayne Partners, and I'm here today to share with you some of our views on the financial markets. When we last talked, I was lamenting the lack of volatility, which had bred some complacency in the markets. I was also lamenting the fact that it had been over 2 years since the U.S. stock market had had a downturn of 10% or more, which has turned out to be the 5th longest time on record for that. Things have certainly changed since then. Starting in September and leading into October, volatility has increased. But I would argue it's just increased back to what would be normal levels. Also, we appear to be in the throes of the market correction that we had been waiting for. Again, I would argue that this is something that might be healthy. There are some sectors in the markets like natural resources stocks, like European stocks, like small company stocks, that are really already in bear market territory. And that has created some opportunities in some of those areas, but not in all of those areas. For those that are unnerved by the increase in volatility and the drawdown in the stock market, I would say this will pass. We need to keep our eye on long-term goals and objectives and factor out some of the short-term noise in the markets. For short-term objectives, we shouldn't really even be in stocks or most other risk assets. We need to keep our eye on your long-term goals and objectives and invest accordingly. Moreover, we had anticipated that there would be a drawdown in the stock market at some point, and we had allocated portfolios accordingly. I'd like to take some time to talk about how we construct portfolios at JoycePayne Partners. How we do this is we start with a strategic allocation. So for each client, we're looking at their individual goals and objectives, their individual risk tolerance, their investment time horizons, and various other unique circumstances or constraints to their portfolio. Then we develop across many different asset classes a strategic allocation that is personalized and customized to their portfolio. Then we develop a tactical allocation where we drill down to the very specific investments that we want to invest in, when we would invest in them, when there should be changes, and what our exit strategy would be. For how we do equity and stock selection, I'm going to ask Jack Payne, our Chief Investment Officer, to talk about this. Jack?
Thank you, Mike. I'm here to talk about our individual stock selection. Our process of selecting individual stocks is based on a proprietary methodology we've developed based on techniques that have been successful for many legendary investors, such as Warren Buffett, Peter Lynch, John Neff, and John Templeton. We look for stocks that give us the opportunity in 3 different areas. 1, equity income. These are companies that pay good dividends, grow their dividends, and have very strong balance sheets. Growth, which gives us an opportunity to participate in some exciting new opportunities, such as Tractor Supply and Chipotle Mexican Grill. We also look for companies that have fallen out of favor, that we call value stocks. These may be companies that are temporarily out of favor in the market, trading at valuations that are well below what we feel are fair value. We may hold these investments for quite some time before the market realizes those values, but we feel we can generate very strong returns from those opportunities beyond what the markets give us.
Thanks, Jack. Now, turning to how we select bonds and debt. Bonds are very different from stocks because bonds are an over-the-counter. You can't invest in bonds on a stock exchange like you would with stocks. So it's a very different method of selecting bonds and debt. The most important thing with bonds is getting paid back, followed closely by getting a decent premium over inflation. So what we do is we get offers from bond dealers around the country on various bonds and debt, although there are often times where we're looking for a very specific credit. So we are going out to the bond dealers around the country to search for the specific credits that we think are at least temporarily mispriced. What Connor and I then do is we spend a lot of time on credit analysis, on price discovery, and then on negotiating the price of the bond, which again is a little bit of a different story with stocks. One of the important things there is to protect against interest rate risk. We think that interest rates are going to go up more at some point. They're up pretty considerably from last year, although they have dropped a bit this year, but they're not even close to being back to the 2013 levels. But at some point they're going to go up, and that is a risk to bond investors. As interest rates move up, bond prices move down. So if there's even a 1% increase in interest rates from these low levels, for those that have longer term, more interest rate sensitive bonds, that could mean a decline in principal value of 10% or more. We're also looking to, as I mentioned earlier, get a good premium over inflation. Thank you for watching the video today. For more information about JoycePayne Partners, please visit our website at www.JoycePaynePartners.com. To find out more about our current views on the markets, please follow us on Twitter at JoycePaynePTRS. Thank you.